Hey everyone, it is Ian, and I'm back with another trade idea today. And we're going to be going over a couple of things. Number one, we're going to be reviewing an earnings trade idea. And number two, we're going to be using a little bit of fundamental analysis to help analyze the risks when taking a trade. And basically, when I say this, I mean what we're looking at is just like we look at the risks in terms of, implied volatility versus realized volatility, right? Like, if, for example, if we see a stock implying, 30-day IV of 100%, but it's realized 250%, we're going to factor that in, right? And this is the same thing. We're going to be factoring in the fundamental risks with earnings trades because, particularly some fundamentals have a lot of effect on what a stock is going to do. So if we don't think that the risk reward from a fundamental perspective is there, we don't take the trade. Plain and simple. So let's go over this one. It is on Costco, ticker symbol COST, cost. Very creative. Um, Costco reports September 22nd after the close. Quick overview of the numbers. We got an implied move of 3.8%, average move of 2.62%, max move of 8.59%, cumulative straddle performance over like the last 20 quarters is negative 111%, and the expected IV crush on the 10 days 14.67%. Quick overview of the ratios. We got implied earnings move versus its average move of 1.44. We have an implied move versus an average implied move of 1.08. Now, some people will sit there and say, well, this implied move doesn't really look all that expensive. And I do agree. Okay, it's not extremely expensive in retrospect, to its historical implied move. But the fact that we see so much deviation between these two tells me there's probably a consistent premium here. And when we go over to the strategy backtest and look at the straddle P&L, we can see that. Barring a few blowouts that happened, in 2018, which, by the way, during 2018, there was a lot of tightening going on in the markets. The market was a lot less flush with cash, so this kind of makes sense. Retailers were having a lot of trouble there. Besides that one and the end of 2021, we really haven't seen anything out of the ordinary. In fact, it's been really, really profitable to be short Costco earnings with returns ranging typically around anywhere from 20% to 40%. Pretty much every single time. Last one was actually 57% return, and that's what we're going to talk about now. So I'm going to go back to the numbers, the rest of the numbers, billing out the position in a sec, but we're going to really hit this part home. We're going to really hammer this part home, the fundamental risks associated with Costco, right? Why are we still seeing an implied move here? Why is it not here or here or back here? Why are we seeing after this huge pop, and I'll get to what this pop was in a sec, but why are we seeing this after this huge pop not come back down to these levels? Well, I can't give you a perfect answer. I can only give you assumptions, and I can only, and I can kind of validate these assumptions a little bit with data. Okay, so Walmart, on this day, on May 17th, they reported their financials. Look at what happened to their implied move. It shot up from 4.28% to 7.75% on Costco. That's a huge move, a massive, significant move. So, what was going on back during this time? Well, we had retailers reporting earnings. Think TJ Maxx, think Target, think Ross, Walmart, etc. These companies had some of their worst performing earnings calls on record. On record. Ross fell almost, I believe, 25%. Target, I believe, fell 10%. Walmart was in the ballpark. Really nasty stuff coming out of all these retailers. And there was a consistent issue with all of them. Inventory buildup. We can't get rid of our inventory in time, etc., etc. But it all stemmed around inventory. So if that's a fundamental risk, being that Costco is a retailer, one fundamental trick that I thought would be crucial to analyzing if this is a risk on Costco in particular is taking a look at DIO, which is days inventory outstanding. This basically is a ratio that calculates how many days does it take for a particular company to sell its inventory, right? And after doing these calculations, these were the numbers we got. Costco at 33.3, Walmart at 48.67, Target at 69.31, and TJ Maxx at 78.56. So in conclusion, Costco doesn't appear to have nearly as much of an issue getting its inventory off as these other retailers do. Now, this could be due to a multitude of different reasons. This is more like from a macroeconomic perspective. But one thought I had off the top of my head is that Costco is a world-renowned or a country-renowned U.S. Wholesale retailer. When there's inflationary pressures, consumers typically begin to buy in bulk, right? That would make sense. Like instead of me going to the grocery store every week and buying chicken in 1 week, let's say it's $6 a pound for chicken, and the next week I go back at 6.50 and seven. I'm just gonna buy like 2 months worth of chicken at six and freeze some of the chicken. And that's kind of the concept of why I think that Costco maybe isn't having this much of an issue with respect to these other retailers. Because, a lot of these other retailers, they're less wholesale. Like, I mean, Costco, if you guys aren't familiar with Costco, look up what they do in terms of some of the stuff they sell. It's ridiculous. I mean, you could build like a bunker. You could legitimately build a bunker, like a doomsday bunker, and it would just take one trip to Costco to get it done. So, I kid. But anyway, so with that being said, with the fact of the fundamental risk, the major fundamental risks here that's caused volatility on earnings in retailing sectors, we can see that Costco doesn't have this much of a risk. So it lowers our risk side on the risk to reward ratio on a fundamental perspective. And historically, looking at the data, we can also see this has been pretty profitable. So even though this implied move to its average implied move is not particularly high, which by the way, I can also argue might be a little bit skewed because of this significant pop that, it was more so based on, I think, traders thinking, oh, Costco's like Walmart, right? Even though they're really not the same company. They do a lot of the similar things, but one's wholesale, one is more one stop shop. Nevertheless, this seems like a pretty optimal trade. And now the question is, well, what's the best structure? Is it the classic, right? Is it the classic? Is it just, we're just going to sell a straddle, at the money, expiring this week, get our maximum exposure to the event? It's not a bad idea. There isn't really anything in particular. When I was looking at the back tests on, call P&L and put P&L that really signifies like, hey, like you should lean this way, that way. Put P&L was really profitable, for really just 2 quarters. And besides that, it's been pretty poor. Call P&L has, been pretty poor altogether as well. Besides, a couple good quarters recently. So it's probably just best to just go with at the money. Now, the thing that I'm noting is that analysts are expecting a 30% increase in Costco's earnings per share this quarter relative to its previous quarter that it reported. That is a huge jump. That's extremely high expectations. So, if someone is uncomfortable with that, right, you can look to hedge, right? Maybe you think, okay, well, I do think that Costco is this is a profitable trade, but maybe I don't have as much conviction, right? Everyone's different in terms of their conviction and risk tolerance level. So I wanted to go over this. Well, if you wanted to, I mean, you could do a condor, right? But look at the skew, right? We can see down here that this probably doesn't appear to be optimal, right? So what we could do instead, and this comes into contango, we can see that we have a contango range of 0.93. Maybe it's optimal to do a calendar spread. And I'm going to touch upon that in just one sec. Let's go first over what most guys are probably going to do if they take this, including myself, is probably going to be just a short straddle, right? That's typically, what everyone usually goes with. So here I have just some presumptuous forecasts for volatility afterward. You'll probably notice that the IV, sorry, one sec. You probably notice that the IV crush is 15%, and I have, around 33, 43%. This is usually just due to the fact that, if you're taking the earnings position off right after, it's not going to be fully realized right then because there's still moves going on, that could not be related to the earnings drift, etc. Um, so I just, this is just a guesstimate, so to speak. We can see that, if we get like a pancake, this is a huge winner, even on a one lot basis. That's because we're receiving a credit as of right now of 2,000. And we can double check and make sure that, this is correct by just looking at the bid ask spread. If it's super wide, because it's after hours right now, if it's super wide, then you're probably, it's probably not going to be that when you're trying to put the position on during regular trading hours. So it's always important to just go through and make sure with that as well. Um, Now you'll probably notice this, right? You'll probably notice this right here, this calendar spread, right? Okay, let's take a look at what I got going on here. So this is the same contract as this right here. They're the same contracts from September 23rd, 495 puts, right? We got the same IV forecast afterward. But then we have this. We're actually going to buy a monthly option. This option expires in 30 days. The same strike put. And you can see that this has a different volatility forecast. And here's why. If we go over to the relative value tab, it's pretty easy to find. Just run the non-event IV30 and just come down here and we can take a look and we can see the non-event IV30 on Costco is 27.75%. If we go back here, we can see that this is kind of it's in the general range. Actually, let me just bump it up. There we go. So somewhere in here, right? And you're going to notice that this one is going down a lot less than what it's currently quoted at compared to these other ones. And the reason is because for some people that are trying to figure out calendar spreads is because think about it like this option, these options, and this option, they only have 2 days of life left. This option has a whole month. So this one's super exposed to the earnings event. Like what happens with the earnings event is going to significantly affect the price of this option. This one has 30 days. And since it has 30 days, the volatility as well is not as exposed to the option or to the earnings event. Now, this is something that I do like looking at because sometimes calendar spreads on earnings can be a very, very optimal risk reward trade. They're very good for stocks with a lot of backwardation. I can actually show you guys what that looks like really quick. Because sometimes people kind of get backwardation kind of confused. So with the term structure, this is like a perfect example. It's basically where volatility is super high right now on shorter options, and as we get out in time, it's it comes down. Contango would be the opposite. It would be low here, higher here. So just wanted to go over that just to make sure that everyone knew what this was. So you want to look for setups like this on earnings, and usually you're going to see them because like it's an earnings event. These options expire in a couple of days. They're significantly exposed to it, so their IV is going to be extremely high. Usually that's going to be the case. So you're going to look for situations like this, number one. And number two, you're going to be looking, at least what I like to look for is, options that are, say, like a month behind that are less exposed to the earnings event. And you get that through the non-event IV. And the last thing that I personally like looking for is go back to the earnings insights tab. I can see that historically, these realized moves are nothing. Like this one, less around 1%, less than 1%, less than 1%, around 1%, less than 1%, around 1%, less than 1%, less than 1%. You know what I'm saying? Like consistent pancakes is what we like to call them. Basically, nothing burgers, right? It basically just doesn't move, or if it moves marginally. That is when you'd want to put on a trade like this. You wouldn't want to do this on a stock where it's like an implied move of 6% and it realizes 5% on average, but it consistently realizes around 5%. That's when you wouldn't want to do a counter spread. So we can see here, and the reason why, by the way, is I'll explain this real quick, is this break even on the calendar spread is around from here to here is around 2.5%, 2.54%, give or take. Right? Well, the straddle, the break evens are significantly different. They're wider. So that's what I mean by, it's not like it's just the same exposures. You have different exposures. Your break evens are different. So usually your break evens on a calendar are going to be tighter. And since they're tighter, you're going to want to find stocks, like I said, that historically they pancake. And what we can see with Costco is that there's a pretty good chance of it pancaking. So if you want to hedge, if you want to mitigate your risk, get your most bang for your buck, or liquidity issues, this might be better than doing a condor due to skew. So that's all I got, guys. Really enjoyed making this video in particular. I think we covered a lot of bases. I hope you guys learned something. And with that, I will see you guys in the next one. Happy trading.